All right, yet another rate hike announcement today announced by the Bank of Canada, an increase in 50 basis points. But what does that mean? How does it apply to you, whether you're looking to purchase or perhaps you already have a mortgage? How does this directly impact you beyond the doom and gloom of our media headlines? Join me right now in the rest of this video as Trevor, our trusted mortgage advisor, dissects this rate hike and talks about what we're actually seeing and what lenders are actually seeing boots on the ground in today's market. All right. Thank you so much, Trevor, for joining me today on the heels of yet another Bank of Canada interest rate hike announcement. I am Varsha Pasel with Forrestal Keystone. I'm going to let you introduce yourself and please dive a little deeper into what we can expect with yet another rate hike. Take it.
Oh, great. Thank you for having me here. My name is Trevor Bumstead. I'm a mortgage broker with Dominion Lending Centers. As you say, we've got another rate hike from the Bank of Canada. It's a little bit of a mixed bag here. It's a little bit better news than we were expecting. I think most people in the industry, including myself, were expecting a 75-point increase. Good news is it's only 50, so it's a little bit more affordable. I say affordable with a little bit of tongue in cheek, obviously. We're increasing rates either way, but this will impact people's ability to borrow mortgages as well as other borrowing of money. So overall, though, it's a little bit of a good news. Like I say, we are seeing a little bit of slowing, a little static change from the August to September reports, but overall, we're hopeful that this might be one of the last, if not the last change. So,
is that what they're projecting, that this might be one of the last ones?
There's been talk about a little bit more. I'm kind of part of the reason I think they did 50 here is so they could do another 50 in December without going to even a higher number than they want, which is good. Looking at stats though, we are about to start hurdling 2021. So when we enter into January there, excuse me, we'll start to see the higher inflation rates starting then, and then as we hit kind of about March, that's when the inflation really started taking off. So when we get to that and we're hurdling those numbers, that's when we're going to see a natural drop in the rates, or sort of the inflation rate. So,
right. So listen, I'm sure you get this question a lot. And I mean, when anyone approaches me with this question, I always say, please speak to your mortgage provider or I will connect you with one, right? And this includes, personally. So for those of us that have mortgages, or those of us looking to, approach a lender for a mortgage, are you suggesting, or how are you suggesting clients proceed? Do they stay with a variable rate? Do they move to a fixed rate? I know it is not a one size fits all response here, but I'm sure you're receiving this question. So how are you tackling this?
That's probably the most common question right now. A lot of people listen to what's going on in the media. They talk to the big banks. Two things I'll say to that is media wants to scare you because that's how they get their viewerships. And banks want to scare you into a fixed rate because that's where they make their most money, is they get the penalty side. So obviously, it's like I say, it's not one size fits all. I'm a big believer in variable just because of the lower penalties, more flexibility, and also they come with lower rates. So even with the increase that we're about to see, variable is going to be cheaper than fixed. For example, a variable purchase in the new world here, you're looking around 5.05 would be the interest rate, versus a comparable fix on 5-year would be 5.34. Now, obviously, if you were to really want to lock down and do a fixed mortgage, I would encourage a shorter term mortgage, because I think shorter term fixed mortgage, just because I believe we're going to be coming out of this by the end of next year, and that's when we'll start to see those rate drops. So the benefit of doing a variable, we might have some hardships over the next 8 months to 9 months kind of thing, as if we do get another rate increase, but then we'll start to see that rate going down pretty significantly. So look back to 2007, a little bit of different market, which was causing the inflation, but within a year of hitting the peak, we were down 150 basis points, and within 2 years, we were down 400 basis points. So that just kind of speaks to the value of riding it out, understanding the first year is not going to be great, but year 2, 3, 4, and 5 are going to be excellent.
Right. But it's that riding it out portion that is absolutely scary, especially for those that locked in at that, like it was the lowest rate over COVID. And now they've reached, the homes that they secured at those high inflated prices, they're reaching that, that buzzword that's everywhere right now, that trigger point buzzword. They're reaching it, and they are facing some real realities as to how to structure their payment, how to put more money in, how can, I've heard that there's options, whether you put in a lump sum payment or you sort of course, increase your monthly payment or roll it into a fixed. Like, are you having these similar conversations now as well?
Lots of questions about that. Again, rolling into a fix, it's going to actually immediately increase your mortgage payment rather. And then you're going to be locked into that piece for the balance of the term. So you don't get to see that benefit on the backside. One thing to kind of clarify there is talking about the trigger rate. So trigger rate is only applicable with what's called a variable interest rate mortgage. So that's one of two variable mortgages. That's the type of mortgage where your payment's $2,000 and the ratio between the principal and interest, that varies based off prime. So that's where the trigger rate plays in the factor. Right now, we've hit the trigger rate in most cases. I think this one will probably put us over the edge for everybody else. What that is the bank will then reset your mortgage, basically take you back to your original amortization, and they will increase it to what the market is today. So since the beginning, like let's say you got this 2 years ago or a year and a half ago, they'll be adding 3.5 to your interest rate and stretch you back out to your original amortization. So that's only with a small case of people. Most people are actually what's a variable rate called an ARM, which is an adjustable rate mortgage. That's more traditionally what everybody has right now. And that's where the payment changes as principal or prime changes. The benefit of that is that your amortization stays whole. So at the end of 5 years, you're going to owe what you thought you were going to owe. The only problem is your payments do go up as prime goes up. So that's the one that we're seeing most people getting scared by just because of the rapid increase. But overall, all variables are going to be impacted now.
I am so glad you broke that down and explained the difference, because when you're just reading headlines, it is so easy for someone to read and just be like, oh, I'm a variable rate. Oh, my, like not knowing if the trigger rate even applies to them, depending on the kind of variable rate that they have. Right. So thank you for doing that. Now, all is not lost when it comes to buyers, though. In this market, there are still buyers finding success. And in fact, you shared this really good infographic that I'll hopefully put in here or share after this. And it's about our purchase prices today versus at the peak of the market and that inflated price point, right? So maybe you can touch on how your clients are finding success, your mortgage clients, because they're sure the interest rates have gone up, but with the purchase price going down on those specific markets, how are they coming out ahead?
Yeah. So I think the biggest thing is to remain calm through this. Like say, you can't compare the peaks and the valleys and try to say, oh, it's awful now compared to then, or it's amazing compared to then. It's really about the long haul. It's a great time for buyers, I think, still, especially as a first-time buyer, because they're coming in at a higher rate, they're qualifying at a higher rate. And then as things start to go down, they're going to immediately benefit. So in most cases, a first-time buyer, they have to go with the full term of their first mortgage before they really start to see that relief. They're going to start seeing a lot faster in today's market just because of the decline that we should see next year. So that's one piece to it. But the other part is with the rates, the property value settling. It's more affordable. There's less competition out there. They're able to get a property they want without having to go into multiple offers, most likely. Like you would obviously know more about that. But I think it's still really a good time to do that from affordability standpoint. So again, if they qualify for a little bit less, but the property value has gone down as well, it means they don't need as much down payment either. So there's some benefits to that also.
Right. Absolutely. I mean, there's so much doom and gloom, like you touched, with the media out there. But when we're boots on the ground in the market, dealing with client portfolios on a daily basis, we're finding ways to bring them success, because home ownership is still value. It's still a wonderful way to invest, even in this rising rate environment, right? Yeah. So is there anything you want to touch on specifically with today's rate announcement, other than what we've covered?
Again, I'm not a doom and gloom guy. I want to see the positive. I want people to, approach things with an open mind and understand what's going on. One thing I would like to highlight with today's rate, again, what does that mean to the average buyer or average mortgage holder? Basically, it's a $31 per $100,000 mortgage difference. That's it. So it sounds scary, but it's not a huge number. If you owe $400,000, then your payment is going to change by $139,000, I believe. So.
Thank you, Trevor.
No problem.
This was
Thanks
a
for having
really
me.
quick rundown, but I have no doubt we'll be doing much more of these in the future, not just with the rate hike announcements, but also just overall, like even when you touched on mortgage products, you know, there's so many out there. It can't fit, like not everybody is going to qualify for the same thing. So
Yeah.
I think asking those questions, no question is too ridiculous. Just reach out and ask those questions. So I'll include your information down below for whomever wants to get in touch, because you are a wealth of information. Thank you.
Yeah, great. No problem. Thanks again for having me.
Thank you. So there you have it, a quick little rundown. All is not lost. If you are actively saving, if you are actively looking, and if you are actively pre-qualified in today's market, we wish you all the success. And as always, if you have any specific questions, please reach out to me or Trevor, and we'll get you sorted. And all the best with your home buying and investing journeys.